So we have previously discussed the increased electricity demands that are a likely byproduct of the build-out of AI infrastructure. And we've talked about utilities as a possible way to play that. But we're going to talk about another one today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. So we talked about utilities last week, and just as a refresher, and also for anybody who didn't happen to watch prior live streams where we talked about this, electricity demand in the United States grew very rapidly after World War II. Much more rapidly, it should be said, than the growth of the overall population. And in fact, in the 50 years or so following World War II, or a little bit more, we saw about a six-fold plus increase in electricity demand. And most of that demand comes from residential demand. And one of the reasons that we saw big upticks in residential demand over that time frame had a lot to do with the advent, really, of air conditioning for residential use. That's where the bulk of residential electric demand goes. We also have commercial demand and industrial demand. Commercial demand also is largely HVAC related, and secondarily peripheral business equipment, and of course manufacturing. You can imagine what that would be used for, although HVAC certainly plays into that as well. So that explosive growth in electric demand that took place in the post-war era slowed in the aughts, in the early 2000s. And there could be a number of reasons for this, but first of all, adoption of household air conditioning, for example, was essentially completely commonplace by that time. And also there were improvements in efficiency. I no longer live in Texas, but when I did, we were using heat pumps basically to heat the house in the wintertime and to cool it during the summer. That was a much bigger deal because, as you might imagine, Central Texas summers are quite hot, and we had a lot of space to cool. And that was actually quite an efficient way to do it. If you fast forward, in fact, actually the EIA, the Energy Information Administration, one of the things that they published was that if you took a look at all of the sequential power demand declines in the United States since World War II, and I think there was something like 11 in total, 8 of those took place after 2007. Now, of course, we have 2 potential drivers which are going to increase electric demand somewhat significantly. The first, of course, you probably see driving around all the time now, which is electric vehicles. 6.9%-ish of new cars sold, I believe, was the last statistic I saw. In some places, they are trying to get it to be almost primarily or all electric vehicles by 2030. And in any case, the objective was to get to about 50% new vehicle sales by 2030, which is less than 6 years away. So this is going to create some material increase. Although, according to the IA, the incremental demand associated just with EVs might be a little bit less than you would expect, but it's there nevertheless. So the downward trend in electric demand would have leveled off and actually begun to grow a little bit, arguably, just based on population growth, migration patterns, which have generally been from north to south. But more recently, the biggest driver, of course, is AI and data center demand. And I think this was probably an underestimated source of electricity demand at first, but certainly we've seen news more recently, including deals by Oracle and more recently by Microsoft. Microsoft, I'm sure many are familiar with the story from last week. Microsoft negotiating for one of the reactors at 3 Mile Island to be restarted to power one of their data centers. So that gives one a sense, if one company, granted one of the largest technology companies, but if one company wants to restart a nuclear reactor, what kind of incremental demand we're actually talking about here. So simply restarting nuclear reactors, many of which, by the way, it should be said, were already on a second life before they were more recently decommissioned, because in many cases, these nuclear reactors were essentially commissioned and certified for use for a certain period of time. Oftentimes they got their licenses extended. And then, of course, to restart a mothballed reactor is going to extend that even further. Presumably, this is not the final solution. So, I was just giving it some thought and thinking, well, what other industries benefit from a build-out of electric generation? And of course, EPC companies, engineering and construction, procurement and consulting businesses would certainly be examples of that. Bechtel, which is not publicly traded, but the one we're going to talk about today, is Fluor Corporation, and I have a slide on one of my screens here which we can show. There's a lot on it, and I happen to highlight a couple things already just to get to it. But as we think about energy demand, I highlighted just a couple things. This is from a recent presentation. I think they gave this presentation back in August, but I just bring your attention to the things I've highlighted in yellow. Liquefied natural gas, we have an excess of it. There are other developed parts of the world that are net importers. This is an area where obviously they have something to offer. Small modular reactors, also known as SMRs. Now, this is kind of an interesting area. On the right-hand side, you'll notice under the mission solutions, I just talk about, I don't talk about, but they talk about, and I highlight the company having involvement in both building new operations, decommissioning old ones, all that kind of stuff. On the SMR front, there is a company here in the United States called NuScale. It's publicly traded under the ticker SMR on the New York Stock Exchange, based in Oregon. Now, this was a company that was going to build out, I think it was a 50 megawatt SMR. They spent about 10 years working on that project. Now, this is a company that's had a couple fits and starts along the way. They were initially backed by a company called Kenwood, I believe, which ultimately ended up being under investigation by the SEC for a Ponzi scheme. What ended up happening was that Fluor Corporation stepped in and essentially came to the rescue of this business and became NuScale's largest investor. And it, in many ways, would seem like a good fit in any case, because in order to build out an SMR, a company like Fluor would likely have to be called in any case. And I mention this because I think that there is some promise, and a lot of people believe that there is some promise to small modular reactors to meet, both the incremental demands related to AI and to other things. But it's a pretty speculative investment to get in and chase those companies directly. So to put things in perspective, NuScale, which is effectively a Fluor subsidiary, I believe they own 60% of the company at this point. So what happened was Fluor made a PIPE transaction, private investment into a public equity, and this was all also a part of the fact that NuScale went public through a merger with a SPAC. So it trades on the New York, but this is not a company that would probably have gone through a conventional listing process because it's effectively a startup. We're talking about a company with less than $14 million in annual revenues and a $2.5 billion enterprise value. However, they are working on doing a deal potentially overseas. There's a project called RoPower, which you can look into if you're interested. But the reason the NuScale SMR seems interesting to me is that they have already gone through some of the initial licensing processes in North America. And in fact, we're very close to potentially getting one going in the Northwest before that deal got killed in 2022. In fact, they received a lot of money, I believe, from the 2022 Inflation Reduction Act, which unfortunately demonstrates that you can have a lot of government money flow into projects that end up coming to naught, as that one did. But AI, on the other hand, financed as it is, the build out for it, that is, by large technology companies like Microsoft, Oracle, and the like, you might actually start seeing some private capital, and one hopes that it would be more effective than some of these other things have been. In any case, I think investing in Fluor might be a more attractive way to do this, because I think it's a fine investment even if NuScale doesn't work out, but if they do, it's a real potential opportunity there. So let's take a quick look at Fluor. So as you know, some of the things that I usually like to look for, top line growth that meets or exceeds either the greater of the inflation rate or economic growth. At least in the near forecast, that is the case for Fluor Corp, which is estimated full year-on-year top-line growth to be about 12.7%, a little under 9% for 2025 and 7% for 2026. But you combine all that with the fact that the company is at present trading a little over 16 times forward earnings. So a significant discount to the broad market. And in conjunction with that, in a couple areas of business that I think are likely to be critical, and I think these are likely to be critical regardless of the outcome of the election. So I think, first of all, their subsidiary received a lot of money from the Inflation Reduction Act, which Kamala Harris is a part of the current administration, so makes some sense that at the very least that portion of the business should benefit from this. But both candidates are talking about trying to, aggressively produce energy, and that's a big portion of their business. So let's just take a look at how these businesses break down. So you'll notice that Energy Solutions, of which that SMR portion would be a part, is slightly less than half, about 40% of the top line revenues. But if you go down to operating income, you're going to notice that it's actually about 70% of their operating income. Company does not report until after October expiration. I think it's the 25th, if my memory serves me correctly. Oh, no, first week of November. Okay, so that's going to be a big week because that's going to be election week. But what this suggests is that there's probably not going to be a whole lot of movement in here through the end of October. So I think selling premium, arguably in the form of strangles or something like that, just as a way to get an offset and buy some longer dated upside, might be a way to play it. Are there, okay, so I'm going to just take a quick peek up here. So you're asking if there are any near-term catalysts for Fluor. Okay, sure. So let's just take a quick peek. I mean, we have nothing on the corporate docket per se. Like I said, I think the election could potentially be. We can also take a look at some of their comps and see. I mean, like I said, Bechtel not publicly traded, but that doesn't necessarily mean that there's nothing. Wow, this thing's really flying here today, isn't it? But yeah, I think it's going to be relatively quiet between now and the end of October. That said, bear in mind that they are in a permitting process. They do have, so they've submitted a proposal for this RoPower deal. My interest in this is not so much about the RoPower deal. I mean, obviously, you should never sort of bank the construction of these reactors until it actually gets done. I mean, the amount of time involved to make these things actually happen is incredible, and very often they don't. Which actually brings up another point, which is the cost of generation, which I believe that the estimated construction cost is about $4,200 per kilowatt hour for one of these SMR plants that NuScale would develop, which is actually slightly less than a coal-fired plant with carbon sequestration, which is like $4,800, I think, but substantially more than a natural gas plant, even with sequestration. But it does seem like that's falling out of favor a little bit, and the DOE has been offering incentives and things like this. So there is, I think, a real interest in doing these kinds of deals. But again, NuScale is not, it's essentially a pre-revenue business. $2.5 billion enterprise value, 13.9 million bucks. Actually, let's just it trades under SMR. We can just take a quick peek here. Yeah, $2.5 billion enterprise value, $2.7 billion market cap, just a function of the fact that it's got 130 million bucks in cash, but bear in mind it's burning about 100 million a year as well. So, I wouldn't really count on that. And this it's going to take some time for this to actually turn into a cash flow positive business. But that's not hugely critical if you're an investor in Fluor, which also can benefit from LNG buildouts. They're involved in other areas of energy, including the oil and gas business, including other types of electric generation, among other things. I mean, they're just a big engineering and construction business. So let's just take a quick look at the term structure as well before I start taking some of these questions too. Cost. Okay, so I'm going to get to that because they've got earnings coming up, so I think that's kind of interesting. So you're going to notice, and I'm just going to get rid of this. So as we take a look at this, the first expiration after both earnings and the election, you see quite an elevated implied vol. So my thinking is buy Jan or March options, call options, maybe the 50 calls, sell Haxk strangles against it, and when those roll off, depending on where the price is, we're probably going to look to get into something like a strangle swap, short Nov, long March, most likely. So let me just pull that up. And by the way, I mentioned, let me see this, just a quick point. So we're talking really about two consecutive trades here. One long call, short strangle, and then secondly going to a strangle swap. So I'm not interested necessarily in buying puts and Fluor longer dated at this point. So let's just build this out so we can get a sense of what something like this might look like. Maybe get the 47.5 calls going here. And then we're going to sell a call and put. Near dated, Haxk. And we're looking to, and this is, we can see it's not even a month to expiration, right? So something like this. So mildly bullish here, looking to collect a little bit of premium, 60+% probability of profit, and short amount of time to expiration. Now, once that rolls off, depending on the pricing, probably looking to move to a strangle swap. I'm thinking probably March, November. We're going to see how the term structure looks at that time and what the implied move is at that time. Right now that's still a little ways off, but it looks like the implied move at the moment is give or take 7 to 8%. So, we're going to be looking at a move of about $3. So a $3 strangle swap would get you somewhere in the neighborhood of we'll call it a 50 strike call on the high side, which is actually, I think, what we're looking at here. And then assuming that we're at the current prices, maybe the 45s or the 42.5s on the downside. Okay, so just wanted to point that out. It's tangential to the AI business and to the utility trade. I thought it was kind of interesting. And yeah, so one question just popped up, and I will answer this. It's the last one, but I'll answer it first. Ever going to be on Fast Money again? I mean, I was on last Friday, I think, for the full hour. I'm not sure if I was on Fast twice last week. I did it on Friday. I did halftime, and I think another Market Navigator. So I think I did CNBC a couple times last week. I believe I'm on this Friday. Again, maybe for the full hour. Let me just double check that. Let me see. Some reason I believe, is Friday the 27th? It is, right? Yeah, I think I was, I believe I was, I think I'm going to be on Fast for the full hour on Friday. So, subject to change. But yes, if you're interested in chewing up the hours of 5 to 6 on Friday, you can tune in for that. But you won't be able to interact, of course, when I'm on that one. So if you just watch this live stream, then you can pop in questions like that, and I can respond to them, as I just did. Okay, so I'm just going to go to the beginning of the queue here and start with Steve Garcia, who asked lots of news from China about its worsening economic troubles. So why is China tech, and he talks about KWEB, the ETF, Baba as an Alibaba, Pinduoduo, Baidu, etc., going up. Okay. Yeah, it has been catching a lot of news lately. It's kind of interesting to me. This is like the slowest train wreck imaginable, because what's really going on in the China economy was that they materially overbuilt, materially over-leveraged on the real estate side. And in fact, the investment in real estate amongst individuals in China is substantially greater than it is in, say, the United States, where people are allocating more to things like stocks and so on. There is not an easy way to deflate a bubble without collateral damage. And, I'll share an anecdote. I've not been to China myself. I have been to Asia, I've been to South Korea, I've been to Malaysia, I've been to Singapore, I've been to Thailand, but I've not been to mainland China. I have a good friend who was working there for a time. And to help describe just how overbuilt it was, he shared the following story. Doesn't speak Chinese. And he lived in a tower block. There were 4 matching, he described them as 50-story apartment buildings. And they were all essentially identical. But he said a lot of the buildings in that area all looked very similar. And, he doesn't speak Chinese, certainly doesn't read it. And when he would go to work and he would come back at night, he felt like he could very easily get disoriented. So to make sure that he could catch his bearings and know which building was his, he would leave the lights in his apartment on. So give that some thought. Noodle on that one for just a minute. 4 50-story apartment buildings, so unoccupied that he would be able to identify which one was his by leaving his apartment lights on. Now, it could be apocryphal, despite the fact that this is coming from, a close friend of mine. There could, of course, be a little bit of hyperbole in here. But it does sort of paint the picture. And that's not the only time you've heard a story like that, I'm sure. I mean, there are stories about apartment buildings going up and people buying apartments sight unseen in cities they've never visited, speculating on these things. And the apartments don't have things like running water. and the buildings aren't even plumbed for it. This is just it's a disaster. Now, how is it possible that that could be coming undone at the same moment that things like KWEB, Baba, Pinduo, and BIDU and things like that are recovering? Well, first of all, Alibaba was trading ludicrously cheap, and secondly, it's kind of not a real estate play. So let's just take a quick look at that. Now, I don't like investing in areas where, and this is in yuan, so let's put this into dollars just so we can get some perspective. Where is that? Oh, here we are, sorry. So, here you have a company that's trading 9 times full year earnings estimates. I say full year, it's really fiscal year. Fiscal year ends at the end of March. But, $9.14 is trading 90. It's less than 10 times full year and less than 9 times next year's earnings estimates. Massive amounts of free cash flow. I mean, this thing is dirt cheap by almost any measure. And why? Well, the reason is because if Xi suddenly takes issue with you, it doesn't matter if you're Jack Ma, suddenly you can disappear for a while. We've seen this in other areas with autocratic regimes. Saudi Arabia and MBS comes to mind, bringing all those Saudi princes in, purportedly to have a meeting, and then basically locking them up in their hotel rooms until they concede to certain things. Well, this is the risk when you invest in China, that a capricious government can do anything they want at any time for any reason or for no reason. And that presents a huge risk. But as capital flows into other areas of China, the parts that they are actually trying to promote, of which this is a part. Now, what's interesting is, one of the things that they are talking about that Xi has specifically tried to promote is the notion that they want to build out essentially local consumer demand, that they don't want to just be, the manufacturing hub for, although they want that, of course, but that's not their only objective. They want to start building out more services, presumably more technology, as they always have. These companies represent that. I think they formulate an attractive relative investment. One other potential reason that I could think of is that it's not that the country cannot afford to have a complete collapse of their real estate markets and their stock markets simultaneously. And the government can, will, and does intervene. They're not going to suffer that kind of a black eye, and they don't want to go into a depression. They need to figure out how they're going to manage the real estate crisis, and some of that cannot be managed that effectively, because if those stories are true and you have tower blocks going up with no plumbing, that's not real wealth. And that's a net loser. That means that money was invested either in the form of debt or equity, and it's gone because those buildings are not of much use. But I think it's a relative thing. Chinese equities are also quite attractive on a relative basis compared to the United States, where valuations have gotten quite rich. And we're going to be talking about one of these, which is Costco, in a second, because it's a great company. It's just gotten too rich. So, this is, I think, one of the reasons why we've seen a little bit of a bid to these names. I think it's fine to allocate some. I almost feel like not allocating some to something like KWEB or FXI, or even a handful of the companies that you might pick out, which I have done, like Baba. I've on a couple of occasions just felt like this company is not going to go out of business. It's just too good if the numbers are to be believed. That's another important thing to remember. So aside from capricious governments, bear in mind that we're looking at numbers and we have to have full faith in those numbers. And I will always have less faith, not always, but so far I will have less faith in the financial statements of companies in China than I would, for example, New York Stock Exchange listed publicly traded companies in the United States. We, for both good and ill, we tend to be pretty diligent about pursuing malfeasance in that area, and I therefore believe it's more trustworthy. And so you have to discount businesses based on that. You have to discount businesses based on capricious governments. And you have to incorporate the fact that they are indeed going through a major economic upheaval, and it's not one that is quickly resolved. But when you do resolve those problems, it is usually policymakers that come to the rescue, and they can, and I expect that they probably will to a degree. So whether it's KWEB, whether it's FXI, whether it's BABA, yeah, I think that's fine. So KWEB, you said the March 30 calls. Let's just take a quick peek at that. Where's my options play? And let's just take a look at vols too. I mean, the good news about it is that almost any vol you pay, it's kind of hard to imagine. So the 30s out to, first of all, I like the fact that you're going out to March. So that gives it some time to pay off. And I mean, it is a, you know, I mean, you need a 10% move, basically. But, you know, it's 36 delta. I think that's fine. Let's take a look at the term structure and see whether it makes some sense to sort of calendar that off a little bit, maybe. If this gets steep, that is to say, you know, it's inverted to any degree. That's material. So in here, you're looking at March. Here again, looks like the election. I'm kind of a little bit surprised by this. I mean, I'm sure that our election is going to have implications for risk markets around the world, including in China. But that seems like quite a bid to me. Let's see where you could get that. Where could you get a 30 call calendar off? Let's see if there's actually. So if we actually sold a no regular way 30 call, how much are you going to get for that? More than, you know, more than 1%, 1.5% of the strike, 53 days away, and almost half of what you get for owning the February option. And was it February that you're looking at? What? I think you said March. March, sorry. There we are. So then you get something like that. I don't think that's so bad. That looks reasonable. You know what? Maybe you just gave me a trade idea. I hadn't actually been trading KWEB and BABA recently, partially because every single time I felt like BABA, all right, and I've said this on air as well. I mean, it's a matter of public record that I've said this a couple of times. You know, BABA has been cheap for a while. They can get cheap and they can stay cheap for prolonged periods, and they can get cheaper, make no mistake, especially when you have legitimate reasons to be concerned, as like those ones that I just described. But that's a way you could potentially play KWEB. Okay. So, aloha FinWest. Happy Monday to you, sir. Ranjana, what do you think of the October 57 cash secured put on Kroger, KR? This is slightly in the money, or would you pick an even higher strike? Okay. So, couple things to think about. I've said this. This is kind of a loose rule of thumb, but it's kind of a starting point. You know, at least 2.5% out of the money if I was going to do a covered call, 1% in premium monthly as a, you know, to collect. That's a starting point because you have to ramp that up if a company is riskier or it has more balance sheet leverage, and you might relax those rules a little bit in cases where the business is less risky and it has no balance sheet leverage. But just as a starting point, that's something to think about. So I'm going to cue this up here for those who are, you know, just wondering. So selling a cash covered in the money put is functionally equivalent to essentially doing a buy right, buying the stock and selling a call of the same strike and expiration. So I'm going to put them both up so we can both illustrate that and then take a look at them. I happened to see that message come in before we went live, so I know that they don't go X until after that expiration date. So dividends are not going to play into this trade within this expiration, whether you're doing a cash covered put or a buy right or a covered call or whatever. But it was the 57s. Okay, so the stock is 2.5% out of the money. Does it meet that requirement? Well, it comes in just a little inside of that, right? So 57, 58-ish as a starting point. Again, we haven't made any other adjustments. The other thing is collecting 1% per month, give or take. So the October 25th expiration, and so that's the 57 call. That's here, okay? Now I'm going to do the same thing except do the 57 put. Remember, you're selling this because selling this put, so you can see these two things are approximately the same. And now let's just do that same thing. Oh, oops, sorry. And we'll just make this the 58 put instead. Notice, by the way, for those of you who are looking at this and just seeing me flip around, that one of the benefits that weekly options offer is more granularity, because they'll have, as is the case in Kroger, dollar strikes. Okay. So here we go. Collecting $1.73 on the 57s. Now, obviously, it's closer to at the money, so your decay is going to be greater. That greater rate of decay also means that your downside break-even is going to be higher. So first of all, your downside break-even in the case of the 58s, 55 spot 61. And in the case of the 57s, 55 spot 27. Slightly higher probability of profit for the same reasons. I think it's, I think it's pretty much 10 of one, half dozen of the other, almost in this case. But let's just take a quick peek here. Because you don't have, let's see if we have any other big catalysts. We have that Albertsons thing, but we don't have earnings. What else is on the horizon? Do they have anything that's coming up? No. So, yeah, I think either is fine, because they're very close to those, that sort of set of guidelines that they have. You're inside of, call it 45 days, which is probably 45 to 60 is about as far as I would want to ever push those trades. In some cases, you get less choice because if it doesn't have weeklies, you might only have the first 2 months. Maybe the first one's a little bit short, so you go out to the second month, for example, and get out past 30 days, maybe 45 or whatever, which is fine. But you can still get that same 12% annualized rate of return, 1% monthly, 1.5% over a month and a half, or something like that. So, yeah, I mean, I think both of these would appear to work. Because there is no catalyst, and I think, let's take one last look at one other thing, which is let's just see how this thing is doing lately. I know we caught a bid in here at long last after. Ignore the buy and hold as always. So, we've got 22 indicators here. 8 of them would be bearish. The rest are bullish here. Let's take a look at the candle chart, see what that's got for us. Again, oh, by the way, for those of you who want to own the stock and are thinking you're going to sell calls, you can see, I mean, it's likely to run into some resistance up at 58 in the near term, because that was the highs back in April. But 57 is fine too. I mean, because you're actually going to be collecting enough premium that it would not actually be worse than a 58 sale, because you're going to be collecting enough premium anyway. Remember, it's $1.73 in total yield on the 57s with the stock trading 56.15. So it's 85 cents in the money. You're collecting 90 cents over between now and October 25th expiration. So it's 1 month, 90 cents over 56, 57-ish. It's a fine rate of return. And I like it, and I like the valuation. So either would work. Okay. PC says, what is a typical intraday trading pattern? Do you have an average half-hourly data by volume? Is volume high in the first 15 minutes and large institutions come in starting 2:45 to 3? What about options? Okay. So first of all, we do look at volumes throughout the day in general for options for stocks. And actually the way I do it, and I think most folks do, we just break it out evenly, even though that's not how it actually trades. There will tend to be a lull around the middle of the day, 12 to 1-ish Eastern. You don't generally see quite as much flow as you do in the first hour of trading or the last hour. Flows are definitely higher in those periods in most cases. On an individual contract basis, though, it isn't really that, unless you're dealing with something that just trades a massive amount, like SPY or NVIDIA or Tesla or Apple. It's almost impossible to look at volume intraday as anything all that meaningful. And the reason is because for any given options contract, bearing in mind that almost all of the significant options flows are concentrated in the top 50 names, and even that is concentrated arguably in the top 10. Other individual options contracts, I'm not going to say they trade by appointment, but they just don't trade continuously. And it doesn't really matter. We're looking at Kroger. We can pick a symbol. We'll look at it, and I'll show you what I mean. So here we are. The most active contract are the no 55 contracts. Okay, so we've had 1,500 contracts of those have traded today, and we're going to see the volume here on the bottom. Oops, it's 3 days. So let's just look at one. When you're dealing with an individual contract, we can see that all of the flow in this contract took place between, what is that, 11:45-ish, 11:40, and just after 12, right? And those were probably just a couple big blocks and a very likely part of the exact same trade. That is to say that it's not like this thing is trading continuously. It sort of trades by appointment. And so a trade took place. And what are you going to gather by taking a look at the intraday volume in that contract? Let's look at Flora. We were just looking at another example. It's not a huge company. Actually, wow, that thing's traded a ton of volume today. What's going on here? I wonder where that all picked up. Because I came up with this idea over the weekend. People are reading my mind or something. Looks like the March 50-60 call spread trade. Well, let's just take a look. That's probably the March 50-60 call spread trading, right? 5,000 each, 5,002 of the March 2025 regular way expiration 50 strike calls, and 5,000 of the 60s. That's probably a 5,000 lot call spread. Well, let's see. So we take a quick peek. Sure enough, there we are. 234, 5,000 of the 50s, trade 350, and right here, multi-leg floor trade. Okay? So somebody else likes my ideas, although they're not trading it exactly the same way. But there's another option idea for you if you're interested. Some institution likes it as well, wants to trade the 50-60 call spread, and you're going to see that on this thing too. So that traded 234 exact. Multi-leg floor trade $1. So they paid $250 for a $10 call spread. All right, 3-to-1 payoff out to March. Those of you who watch a lot or trade options a lot will know one of the things about a trade like this that's important to bear in mind, and that is that if Flora by some miracle shoots up to 60 in the near term, unless it's a cash deal like a takeout or something like that, it's not going to trade to the $10 distance between the strikes straight away. You have to wait for time to pass. So the way to think about it is that if you have a debit call spread and it rolls in the money, time is in your side in one sense, which is that decay is now paying you, but it's against you in another sense, which is that it's not going to go to the value, its max value very quickly. Whereas if you simply bought the 50 calls, it would. The exception being if there is a specific identifiable catalyst that's going to, force the stock up and force volatility down. Amongst those kinds of things would be something like an acquisition. So Bechtel says, oh, we want to buy. Not that I think that would necessarily be allowed to happen. I have a feeling there'd be some monopoly concerns because there's a number of big EPC companies, but if two of the largest were trying to merge, you can imagine that would probably face some scrutiny. But let's take a look at what 60 bucks, that's interesting. This is the stock over the course of the last 5 years, as we can see. So somebody's making a bet on 500,000 shares that this stock's got 20%, more than 20% to the upside potentially over the next 6 months or so. I like it, obviously. I wouldn't have mentioned it on the long side if I didn't. So there is that. Okay. So again, just going back to this intraday volume thing, tough with options because they just don't trade that regularly. Now, if we look at something like NVIDIA, I'll bet you the most active contract, unless it was a function of just one, big individual trade, probably, so the weekly options, this thing traded just tons and has been trading continuously pretty much. And then you can look for little spikes, things like that. But, you were asking the question, is most of it going to be concentrated around the open and then secondarily around the close? Yeah, the answer to that is yes. That's the pattern. And look, perfect example of that. All the volume we saw, huge percentage of the volume took place before 11. And then we can see it picked up around 3:15. And we got a couple big prints in here. So it's not continuous. There are typically lulls. But then, for most stocks, we have 3,700 optionable single stocks in the United States plus ETFs. For most of these things, they don't trade that much volume, really. And so when you're outside of those top names, it's not as easy. And I'm not sure if the reason for your question, just a quick point, and that is that a lot of people will say that they like to look at technical patterns, technical behavior over small periods of time and medium periods of time and long period of time as they're sort of kissing cousins of one another. In vol space, that's definitely true, which is to say that there should be a relationship between how volatile a stock is over an hour and a day and a week and a month and a quarter and a year. And some relationship does exist, but it's not perfect. But when you start taking a look at using those kinds of technical things and getting down to the very, very small slivers of time, in cases like this where something may not have traded at all or may not have even traded for days in some cases, it gets very difficult. Hi, Mike. I am long a Meta calendar like Meta. 550 call calendar, OCDs. We're now through the strike and there's still plenty of premium on the short October leg. Any thoughts on how to improve my position or trade? Well, first of all, like I said, like Meta, cash flow generating machine, and it's definitely in a bullish pattern and no reason for that to necessarily stop. Which you're gonna call Oct. So I'm assuming when you say October regular way, I know there's a little bit of a lag, but you can just throw it in there if you want. Makes a little bit of a difference because the if it's really short, like the first week of October, it's coming right up. then you don't have to concern yourself quite as much, and you can let that one ride out and just benefit from the fact that there's a lot of decay. Regular way. Okay, so that's October 18th. Yeah, remember what I've said. I've talked about this before. I like to look long or short at potentially adjusting my options once the delta gets above 60, because on the short side, very likely to take assignment, and on the long side, I'm just losing that convexity, which is probably the reason I owned it in the first place. And I'm usually looking to roll that out, into that 30-ish delta area. So if you're just going to roll up, you would be looking at going to, and you could look to roll both legs, so you're going to monetize the long side as well. You could be looking to go up to, say, the 585s, right? That's 34 delta option on the short side, and or even a little bit higher, or go into a diagonal. We have, in terms of events, just seeing whether we can push that out in time a little. You could. Stock goes X on the, let's see, what do we got here? Oh, you can't actually, no, because we've got earnings on the 25th. How big's the implied move? That doesn't seem right. That, oh, you know what? Okay, so if you're doing, I'll bet you anything that's because the implied move is getting thrown, I'm going to guess, because the term structure probably has an election bid in it. So this is just an important public service announcement, and it just occurred to me even as I was looking at this. I was thinking the implied move, 3.7%. Remember, if you're calculating the implied move 1 week out, the most common way to do that is just to take a look at the straddle, at the money straddle, and that should reflect, give or take, the options market's expectations for the mean absolute deviation, which is just another word for the implied move. However, when you look at services like Bloomberg that are calculating implied move based on 2 expirations, the thing that it's doing is it's taking, okay, I have earnings, let's say earnings take place in 10 days, so I look at an options expiration that expires in 14, and then I look at one that expires in 45 days, right? So a 2-week option and a 1.5 month option. And basically, a simplification of how it's thinking about it, the calculation, is that there's a baseline volatility and there's an event volatility. And the first set of options includes the baseline volatility plus 1 day of events, and it came up with, let's say, 40 vol. So you have a 14-day option, 1 day of events, 13 days of continuous vol. Then you have a 45-day option, 1 day of events, 44 days of continuous vol. And then you just back it out and you solve for the difference, right? So if the front was 40 and the next one is, say, 35 vol or 34 or something like that, then you can essentially solve for the difference, because you can make an assumption about the underlying volatility process and then the event variance. The problem with that, though, is that it's making the assumption that there's only one event. Here we clearly have 2. We can see that in index options. We can see that in overseas stocks, like we were just looking at with the Chinese stocks. We see it everywhere. There is a lot of event variance generally baked into stocks and into the broad market for the election. And that is what I think is happening here. If you take a look at the chart that's on your screen right now and you say, okay, well, you see this big spike here, we know that part of what's going on is that bump that's taking place for the election. And then you've got earnings in the prior expiration. And when you have that secondary event, it's saying that the earnings implied move is very, very low because it's looking at that differential. But that's not necessarily correct. What you really have is you have 2 events, right? So if the average move for Meta is probably, 6, 7%. Actually, why am I saying probably? We'll just take a look. So it's the average move 7.5%. Although we've had a couple much bigger moves recently, not the last one, but several. Within the last 8 quarters, we've had 5 double-digit moves. So what's going on here is if you use an implied volatility calculator that uses that difference, just be cautious if the expiration on the long side is capturing elections, whether it's this stock or any other. It's probably going to throw the math because we can see, as we have seen, there's a big bid to implied vols capturing earnings. And I might almost be inclined to, I'm almost of a mind to sell it because there's 2 things that could happen. You could get Trump or you can get Kamala. And I think by now the electorate's fairly familiar with what those 2 stand for. Or, well, maybe they are. I don't know. My point is that it isn't as if there's going to be some dark horse that comes, from left field. So you have 2 known quantities to a degree. And, it seems like there's an awful lot of volatility built into that when it's going to be one of these 2. One was president, one is the vice president. How much should things really get thrown one way or the other? Okay. Micron, mildly bullish. Yeah, so somebody was asking me about this. Actually, I think it may have been on Fast Money last week. The issue with Micron is that they are in more of a commodity type of business than, NVIDIA is not in a commoditized business. It's their product. They are the end-all, be-all for the time being in their space. Mildly bullish is a diagonal call spread, Sept 27th to October 98th, a good one. Okay, so Jay, just a couple quick points I would like to make about that. And that is that I like calendars going into events. The thing that I'm not as crazy about is when the calendars are such that the vol crush on the longer dated option gets you, and there's nothing else to keep it bid. And what's interesting is that usually the way we try to mitigate some of that vol crush is by getting a longer dated option that captures 2 of the bigger events that are going to take place in a stock, which could be consecutive quarterly earnings releases. So you would want to capture September and then maybe December so that you can essentially take care of that. Interestingly, here you don't need to because you could do what we were just talking about, which is count on the market sort of creating this earnings volatility and try to capture that. I don't know that that's quite as safe because I will say that that's a strange event and what I mean by it is that if the polls break wildly in favor of one candidate or another, enough that people think the election is going to be a foregone conclusion, then the event variance is probably going to see some vol crush. So bear that in mind, right? So whatever your views about the election, uncertainty on election day is what's creating that bid. And if that uncertainty is reduced, then November volatilities across the board are likely to decline. Now, so you have two things that can happen. One is the underlying price action. Is this a bullish outcome for the election or a bearish one? But it's the uncertainty that creates the bid to options premiums. So any definitive break is likely to bring that down. So that's an important point. But having said that, assuming you wanted to get into a calendar, I would try to capture options that have another event variance built into their price. And the Octobers don't have that. So to illustrate this, well, let's see. Yeah, you know what? I think I can do, let's see how I can do this for you, if I can do this quickly. I'm going to do this because it's going to be kind of an educational thing, I think, for folks to take a look at. So what are we going to do here? This is Micron's earnings over the last 44 reported quarters. I'm just going to turn this around because usually I think probably most of you, when you look at something like this, you're used to seeing it go old to new. Hang on. It's not recognizing that as a date. Let me just put that in as a date. Hopefully it'll recognize that as a date. If it doesn't, I can do something else. So what I'm going to do here, no, it doesn't. Sorry. What I'm going to do here is we're going to just take a quick peek at how 30-day implied volatilities changed before and after, because that's what you're dealing with, right? So October 18th, yeah, I mean, you're basically looking out to the next month. It's actually slightly less, but it's going to give us a sense of what the vol crush is. So how much was vol, 30-day implied vol prior to the earnings result, and how much was it immediately following, okay? And what this is going to do is give us kind of a rough estimate of the standstill Vega loss that the long-dated options contract is likely to give you from before to following the event, okay? So Vega, for anybody who's watching and doesn't know, Vega is the price sensitivity of an option for a 1% move in implied volatility. Okay, so if something is a Vega of 10, if implied vol goes up by 1 point, the option becomes worth $10 more, goes down by 1, loses 10, and so on. Okay, so the first thing we obviously want to know then is, well, how much is implied volatility likely to change? And the way we can do that is we can say, okay, well, how much was the 30-day implied volatility for Micron right before the event and immediately after, right? So that's going to give us that number. So, and why don't we do, yeah, so I need 30-day. Okay, let's see. Sorry, you guys are watching me work on the fly. It's not a super pretty process. So let's go like this. So we'll say 30-day implied vol. Is that right? Okay, so you're going to have to forgive me because I am trying to remember fields by memory. That's an invalid 30-day? Is it 30-day? Oh, okay. Got it on the second guess. Okay, so, and now, oops, jeez. It's maddening, I know, to watch somebody typing, especially mistyping. That seems odd. Why is it higher? Do they report before or after the close? Oh, let me just try something else. Oh, okay. So I'm just, that makes more sense. I think it does. It's actually not a very big change. Let's do this. For some reason, I think it's not capturing these events, but this is just my intuition, so bear with me while I do one quick experiment. That ball should be falling. All right, so let's take a look here. We're gonna have a couple errors. So last earnings does not appear to have been that meaningful, but I'm gonna throw that one out, and then we're gonna take a look at that more closely. And then we're gonna do this. We're gonna take that number divided by that number, just in terms of percentages, might be helpful. Okay, and get rid of that bad data point. So, you know, this would upset a data scientist because we're only dealing with, we're playing games and we're only dealing with about 42 events. But 75 bips. So not actually as much big a drop as I would have thought. All right, so, you know, maybe not so bad. Let's take a look now at the term structure really quickly. So you might lose 1 to 2 clicks of all. And not a huge bid to the Novembers. You know, I would just give some thought to this. Actually, November's trading at a discount. I'm fine with the Micron trade. I would actually push it out to November because the term structure is still downward sloping, and we saw that there's a bid to everything else in there, right? So I think what you could end up happening is that the front end of this curve is going to collapse, and this one might actually hold up, and this portion of the term structure here, which is downward sloping because of the high volatility associated with the event, could go the other way because there's going to remain a bid for the election for now. And so you'd be better off owning November because you're probably going to take less of a vol hit because you're trying to benefit from the vol crush on the near side and mitigate the vol crush on the long side. Okay, hope that helps. Next, Costco. Hope you had a good weekend. Costco has expensive options. A credit spread may be a good idea. So yeah, this is an interesting one. Let's talk about what's expensive first, and that is the stock. Yes, I know, even Jim Cramer said it last week. Apparently, I wasn't watching, but somebody told me that he said this, and it's true, that Costco has always traded at a fairly rich multiple. Okay, I'll buy that. I think that's true, certainly relative to their growth. But here's the chart I want everybody to look at. Okay, just look at this for a second and then tell me that you're still comfortable using that as your safety net for owning the stock at its current valuation. All right, this is where we are right now. This goes back, in the case of the forward price to earnings, this goes all the way back to 1986, and our price to sales basis, it goes back to September of 94. Let's look at them in turn. First, did I click that? First, forward price to earnings, okay? Has it traded expensive? To the market, yes. To some of its comps, certainly. But this is the valuation right now. 52.5 times forward earnings estimates is the current valuation for Costco going into earnings. This goes all the way back to 1986. Okay, so we are dealing with 38 years worth of Costco valuations. And it's trading 52.5 times forward. Now, it's had spectacular growth, okay? But is its growth now going to get so much more spectacular that it deserves that multiple? I don't know. and you know, just like I was saying before in the case of Baba, stocks can get cheap, stay cheap, and get cheaper. This valuation's not a timing tool. So I'm not saying because now it's trading 52.5 times forward earnings, because now it's trading 1.5 times sales, both which, for the recorded data that I have, and I'm showing it to you on my screen, are as expensive as it has ever been. I could have said that last quarter when it was also as expensive as it has ever been. I could have said that for each of the quarters from Q3 of 21 to Q4 of 21 to Q1 of 22 to Q2 of 22, and then obviously the first and second quarters of this year as well. At any one of those times, I could have told you that this is the richest it's ever been, and someone could have said, okay, well, I'm going to run out and short it, and it wouldn't have been a good short because it proceeded to get more expensive. But I will tell you that this is a company that, you know, we spend a lot of money at it. I'm sure a lot of you do too. You know, I like the business. I like the recurring revenue that comes from the subs, and they've just ticked those things up a little bit. Consumers are stretched. They're probably buying things in bulk. All of these things are theoretically tailwinds, but these valuations are getting right up there. So now let's take a quick peek at the options premiums and see how expensive these look. So the short-dated stuff actually does look pretty pricey. And actually, I believe on Fast Money, I suggested that for people who own the stock, they might want to consider buying put spreads going into earnings, just because I feel that, you know, this is, you know, it's getting pretty greedy to stay in here at this point. And look, if you've owned the stock forever, it's a real dilemma, right? Because what do you want to take a taxable gain right here, right now? I mean, we're almost at the end of September, 3 months to go to the end of the year. Most people don't like to incur, unless you have some good offsets. You know, people don't like to incur those kinds of taxable gains necessarily if they can help it. And, you know, trading around a long-term holding is rarely such a good idea because market timing's difficult under the best of circumstances. I don't know that the longer dated stuff, like you know, November and, you know, early November, that first one, once again, we clearly see a bid to the election. I wonder why Costco would have such a big impact in that. Corporate taxes, maybe. Trump has talked about, you know, reducing corporate taxes. Current administration and Kamala have talked about raising them. That's obviously not good if you're a shareholder, because it's going to, you know, the multiple goes up if we get a corporate income tax increase. It's not a one-for-one thing, by the way, but, you know, I estimated that, I thought that corporate income taxes could represent a 6.5% hit to S&P earnings if they got the 28% rate that they were talking about. So again, put that into the back of your mind. You know, just lower your EPS estimates by a commensurate amount. They can obviously make some business decisions that can impact that a little bit, but just a, you know, thumb in the wind kind of thing. Yeah, so selling some upside call spreads, I like it in the sense that obviously the near dated premiums are elevated. I like it because I think Costco is at a valuation I'm really struggling with here. Despite everything else I happen to like about the business. You know, I don't think companies are always great at any price, and this is arguably a good example. It also appears that there's more technical indicators that are bearish right here and now than bullish. And remember, as always, exclude one of those. That's the buy and hold. It's just there as a reference point. So yeah, you could sell some upside call spreads or buy some calendars again. Okay, John C. I'm an hour and 15 in. I apologize for that, guys, but there's a couple more questions. I'm just going to skim through this really quickly. I get it if some of you guys, those of you who might be dropping or have already, like, subscribe, and all that kind of stuff. I am going to try to answer a couple more of these questions before we go. Let's see here. Earnings for Meta. So John C., we talked about Meta already. We had somebody who's already in a 550 calendar. I like a 585 here calendar if you're going to play it that way. You could also do that trade. So PC says, high volume means to me that most trading is done at the beginning and end of the day. Yes, that's true. And stock is drifting at other times, except for any news. Okay, so you're just talking about the underlying equity as opposed to the options. But yes, I think that's true. I think a lot of the trading activity does occur immediately following the open and before the close. And more so probably the former. Michael Anthony says, I don't understand why Kraft Heinz, Hormel, and ConAgra, when people must eat and feed their families. So, some of these companies have really struggled from an operational standpoint. Campbell's Soup for a while was a good example of this. But here's the issue that you're getting with something like a Kraft Heinz. And that is that, remember what your objective is. Any business that is not growing at least as fast as the economy or as fast as inflation is shrinking in real terms. And for a lot of these staples food companies, that's what has been happening. A couple of years ago, it was the spice companies like McCormick and so on. Similar circumstance. There was just their unit sales were dropping, and their margins were basically flatlining or declining. And so you had a shrinking business, and I think that's what's going on here. That said, there is a floor because they do provide something critical. And they are trading, again, awfully cheap. So how cheap? Let's just take a look on a forward basis here at Kraft Heinz and go back some period of time. So let's do the same thing we just did with Costco, right? And say, okay, well, where does this sit relative to the historic valuation for this business? And we can see on a price to sales basis, it's kind of languishing where it has for the last 5 years, but cheaper than it had been. Price to forward is actually closer to the bottom end of the range. So if you're kind of thinking, you know, what's my downside? 10%, if just to get down to the worst of it, which we saw, back here in 2019. And if there's any choppiness or volatility, could become a safe haven. We've seen it for other staples. I actually am kind of, in some ways, surprised it hasn't been supported, at least by that, a little bit. And interestingly, in the staples side, part of what's dragging it up is Costco, because Costco is about 14% of the staples index. And so it totally outweighs it. And you take a look at Kraft Heinz, and where are we in there? There's McCormick, which I was just talking about. Hormel, which you had mentioned, is also in here. Campbell, which I think, mentioned at the start of this conversation. These things were all, suffering a similar fate. But I actually would almost favor what you're talking about, which is rotating from the best performing. Yeah, here's Kraft Heinz right here. It's 1.1%. So as a pair, I kind of like that long Kraft Heinz at the lower end of its valuation and short Costco, but not outright short, because I don't generally outright short things. But yeah, so you could sell credit spreads, maybe buy some put spreads. So that's what I actually advocated last week. So that is that. Can you look at Clorox for a put candidate? Wow, implied vol really collapsed, huh? That was because, was that on the 8th? Let's take one last look at that. Was it on the 8th? Was that August 1st? No. What was that event? What happened back then? What happened? Something happened on... Now this froze up on me. Not sure why. There we go. Supplements business, I couldn't have done it. One of you probably knows. What happened on the 19th that I'm not remembering? That hammered vol here. Something took implied vol and Clorox down a lot that day, so there must have been something. Not just the fact that it got caught a bid, I don't imagine. Okay. Well, I had to do a little homework and figure out what the heck that was. So, and there are some, geez, these spreads are, near-dated spreads are terrible. A couple of these things. Regular way is not terrible. Look, I mean, even the at-the-moneys aren't a bad yield. You're getting more than 1%. Not getting more than 1% at 2.5% out of the money, which is what sort of my favorite place, but this is not a high volatility underlier. These weeklies, you really need to watch your executions. You're going to have to use limit orders if you try to trade anywhere outside of the regular way. Regular way at the money straddle is 50 cents wide, the 165 lines for October 18th, which is, you know, I mean, you could use a limit on that. You don't want to just hit bids on a 20, 30 cent wide option. But outside of that, wow. I mean, take a look at the 165 line for the 25th. I mean, the put side's $3 wide. It's ridiculous. And the calls and puts, because it's effectively at the money, should be about the same. So you'd want to work it at $3 and change if you were going to sell the 165 puts. I think any of those are fine. Look for something at the money. This is a yield play, after all, and something you don't really mind owning. And you have that event situation, and you don't have earnings until the 1st. And are there any other events for this company? No. October 23rd goes X. That's it. Okay. Yeah, so I think those are fine for Clorox. They had a major hack. Clorox had a major hack on the 18th, and that got suddenly implied vol plummeted on the 19th. Is that it got resolved? I mean, I saw that there was news about a hack, but why did vol fall so precipitously immediately following that? I would not normally expect that. Maybe they were able to say that the hack wasn't meaningful. I'll have to look for the news and see whether there was a corporate statement at that time. Okay, guys, for those of you who stuck around for as long as this, which is obviously much longer than we usually do this, and it was just because you guys had a lot of good questions, and I wanted to try to get to as many of them as I could. So we stuck around a little bit longer than we normally would. And for those of you who did as well, thank you very much for watching. Like, subscribe, and we will see you back here on Wednesday, 4:15. Thanks for watching.